Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Trading price signals instead of emotional signals. Dramatic and emotional trading experiences tend to be negative. Pride is a great banana peel, as are hope, fear, and greed. My biggest slip-ups occurred shortly after I got emotionally involved with positions. Seykota. It is said that over 90% of active traders in the financial markets don't make money over the long term. There is a lot of confusion about the exact numbers, but it's safe to say that it's difficult to be profitable over time. Even investors have terrible timing on their buy and sell decisions, but why is this the case? It typically comes down to emotions. The majority of the errors that traders and investors make are emotional ones because they rely on internal signals. Their emotions give birth to a buy and sell strategy that is unproven and often unprofitable. We've witnessed this as many of the wild price swings that make no sense in the current market environment. If you want to make a quantum leap in profitability, the first step is to stop buying or selling anything without a solid, quantifiable, external reason for doing so. Greed was the primary driver of the Nasdaq 5000 bubble in March of 2000, not the valuations of eyeballs on websites. Buyers continually piled into dot-com stocks with no real intrinsic value, and held them due to the greed of more gains and higher highs. The Nasdaq 5000 trend could have been traded profitably with the right entry and exit signals. Simple chart patterns and moving averages made many traders a lot of money in 2000. I had enough money in March of 2000 to pay off my new house when I was 27 years old, and I have been hooked ever since. The problem during this period was the traders and investors that traded based on their personal euphoria that allowed them to hold their positions during the parabolic tech uptrend, didn't allow them to lock in profits and exit their positions. Using trailing stops would have helped them exit and keep large gains instead of riding their tech stocks all the way back down. In March of 2009, all major stock indexes made lows that seemed impossible just a year before. The selling escalated because of a fear of holding equities, and sellers were willing to let go at ridiculously low prices. Long-term trend traders should have been out of the long side of stocks and limited losses in 2008 using any reasonable sell. The easiest sell signal for a trader or investor to use to limit the destruction of their capital is to exit their holdings and go to cash when the S&P 500 index tracking ETF SPY closes under its 200-day simple moving average. For stock indexes, this one simple exit signal decreases drawdowns of capital by about 50% in the past 15 years of backtests. It doesn't increase the returns in most cases, but exiting when the 200-day simple moving average is lost will cut the downside in half. You have the option to be in cash during market corrections, bear markets, recessions, and market meltdowns, and you can wait to start buying again when the indexes start closing over the 200-day. This could be the most important signal in this book. The majority of investors and traders would do well to go to cash when the stock market indexes are trading under the 200-day moving average, and wait for better opportunities on the upside. An index tracking exchange traded fund like SPY, QQQ, IWM, or DIA closing below the 200-day moving average should be your first warning sign of danger. Pride makes people hold what they thought was a good investment or long-side trade even though it has slipped dramatically. The only reason to buy anything is for the possibility of it going up in price. Pride is the signal that keeps a trader in a losing position and unwilling to admit they are wrong. It prevents the use of stop losses and proper exit signals. A trader with too much pride won't even understand the need for exit signals because they are blind to the possibility of being wrong. Hope is another dangerous signal used by traders. A trader will buy a stock that is falling lower day after day based on the unfounded hope that it will go higher. Hope is not a dip buying signal. A stock index approaching the 30 RSI and above the 200-day moving average on the daily chart during a bull market is a much better buy signal. You must have a quantifiable, external reason to buy a dip that puts the odds in your favor based on price action and not because you hope something good will happen. Fear is one of the internal trade signals that completely undermine a trader's ability to be profitable. There are two ways to be profitable: have more wins than losses or have big wins and small losses. A high winning percentage system should have wins and losses equal in size to make your system profitable. Likewise, having big wins and small losses can allow even a small winning percentage system to make money, provided there are enough large enough wins. Huge losses will make you unprofitable regardless of big wins or a high winning percentage because you will give back your profits from your winning trades and eventually destroy your trading capital. Fear can signal a trader to take a small winning trade while the profits are still there before it disappears, making it difficult to have any big wins. Exit a trade based on a trailing stop, time stop, or because a price target is reached rather than give in to your fears. It can also make a trader miss a valid entry signal because they are afraid of losing money. Greed can believe in your entry signals too much and often wants to trade with too much position size. Greed is confidence gone wrong. Each trade signal you use should be designed to put the odds in your favor, but even a great trade signal is not a guaranteed win, it's just a possibility with a good probability. Many great trading systems only have 60% win rates. The key is how the trader manages to keep the 40% losing trades small while maximizing the winning trades. Greed can also blind a trader from taking the profits off the table when their profit target is reached. Greed for gains after the risk-reward ratio has skewed against the initial entry can lead to losses when a trend reverses. One of the most expensive things a trader can do is not take profits at their target as the market reverses, instead waiting for the price to recover after it's too late. Greed wants to trade big and stay in winning trades forever. Your trading plan has to override your greed, control position size, and have a strategy to take your profits when they are available. One of the cornerstones of my teachings is that emotions are terrible trading signals. Emotions want to buy falling knives at the beginning of market corrections and bear markets instead of waiting for the market to find key price support levels. Signals are created to give you a quantifiable reason to do the opposite of what your emotions are telling you to do. Your trading success will be largely based on your ability to approach the markets in a systematic way using a trading plan to utilize profitable buy and sell signals that fit your market beliefs and methodology. You need a good external guide that you follow regardless of what your emotions are telling you to do. Trade your signals and not your feelings, opinions, or emotions.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye bye.